Module 5, How to Buy Funds. So investment companies have offered us the chance to invest in funds that track numerous different indexes around the world. Popular investment companies like Vanguard, Fidelity, Charles Schwab, and Morgan Stanley offer some of the best funds for you to invest in instead of investing in single stocks. So Vanguard's VTI is an ETF that tracks the total U.S. stock market, which again means every company within the U.S. stock market. Fidelity's FSKAX tracks the same thing, the total U.S. stock market. Charles Schwab's SWTSX tracks the exact same thing also, total U.S. stock market. Morgan Stanley's MSEGX is a mutual fund where they try and handpick the fastest growing companies in order to beat the S&P 500. All of these firms have hundreds of funds for you to choose from. We'll see how to search for them a little bit later. So before we go any further, I just want you to know that mutual and index funds normally have 4 to 5 letters for ticker symbols, while ETFs normally have 2 or 3. Here's what to look for when choosing an investment company to have a portfolio with. I'm going to give you 6 of the best big boy stock brokerages. Big boy just means established and been here for a long time. Now, pardon me for this, but I do think Charles Schwab ended up buying TD Ameritrade. So I'm going to leave this one out for now. TD Ameritrade was famous for their Thinkorswim platform, which lets you buy and sell stocks at an extremely fast rate. This is most likely the platform that y'all was looking at when y'all would see those day traders making thousands of dollars in a couple seconds. This platform is now at Charles Schwab. So Fidelity is going to be my number 1 pick out of all these. They have the best overall clean user interface and they have superb customer service. Vanguard has the best selection of low-cost funds and they have decent customer service. Interactive Brokers, they have decent customer service, but they have too many fees. E-Trade is an easy-to-learn platform and it's great for beginners. Charles Schwab used to be butt cheeks, but now they're actually kind of decent. They're good for beginners and they have decent customer service too. Here are the top 3 things that your brokerage must have. Number 1, they must have great customer service. Now, I've been using Fidelity for about 5 years now. Fidelity is one of the best companies if you want superior customer service. I have never waited more than 5 minutes to get on the phone with them and everybody was extremely helpful. Number 2, they have an easy to use website user interface. You want the app that you're using to be extremely easy and straightforward to navigate. For me, the best UIs are with Webull and Robinhood. So I normally use Fidelity and Vanguard for my long-term investor and I use Webull and Robinhood to day trade because it's extremely easy to use. Number 3, assets over management over 100 billion. You want the company that you choose to invest with to have billions and billions of investors holding their money with them. For example, Fidelity's asset under management is 4.9 trillion. This means that out of all the money in the world, Fidelity managed almost 5 trillion of it. This lets me know that there are a lot of people who also trust Fidelity to keep their portfolios with them. Here's how to search and compare different stocks. So you're going to be using something called a stock screener. A stock screener is a tool that helps you search for stocks based on specific filters like price, sector, or performance, kind of like using a search engine for stocks. Now, I'm not going to go over how to use a stock screener because this course is about funds. So we're going to use something called a fund screener. If you want a breakdown of the stock screener, then take the Conquer the Markets course. Everything about stocks will be in there. Here is a fund screener in action. So what I want y'all to do is type in this website right here and go to it. So this is how the page is going to look when you click the link. Now what we want to focus on is the Morningstar ratings. Morningstar is a company that is a leading provider of independent investment research and investment management services. We want to make sure the fund we're searching for has an overall 5-star rating. Notice how it goes from 8,907 funds to 666 funds. We want the returns to be above average or higher, which is going to be this 4th box. And we want the fees to be extremely low, which is going to be that 1st box. We're looking for an absolute bargain. You can select active if you want a fund manager or index if you don't, but we'll just leave it open for now. Let's click it and see what we get. Alright, so I know this may look confusing, but stick with me and I'm going to walk it down for you. So here we have the names of the funds that matched our criteria. We got the category that they're in. We have the year-to-date return, the 1-year, 3-year, 5-year, 10-year, and life of fund return. This is going to be the return since the fund was created. You have the net and gross expense ratio, and you have the overall rating. You also have the buy button where you can put money into these funds, but we'll talk about that later. Here are the top 3 tips when using a fund screener. Number 1, when comparing funds, look at the return of the life of the fund, the 10-year return, the 5-year return, and the year-to-date return in that order. So if we were to click life of fund, it will sort out all of these funds by the best and worst returns since the funds were created. As you can see, the fund with the best return since inception is the Fidelity Large Cap Growth Index at almost 18% per year. Now this leads to the second tip. Always look at the inception date or the date the fund was created in order to get a better understanding of the inception return. So if we were to click the fund's name, we see a little bit more details. It will give you a graph that tells you how much a hypothetical $10,000 would be worth if you invested during a selected time frame. You can see the top 10 holdings, which will give you the top 10 holdings of the fund, and you can get a fund overview where you can see the objective and the strategy the funds use. What we're looking for is the fund inception, and as you can see, this fund was created in 2016. Now 9 years for me personally isn't enough proof that this fund can survive different stock market crashes and periods of uncertainty. Although the top 10 holdings are amazing, personally I only still invest in funds that have been around for 20 or more years. A high return of 18% per year sounds amazing, but that's only for the last 9 years. Let's find something that's been around for much longer. So we're going to go back and we're going to click on FXAIX, which is the Fidelity version of the S&P 500. As we can see, Fidelity created this fund in 1988. Now in this specific case, the inception date doesn't really matter since we all know what the S&P 500 is, and this is just a fund that tracks it. So even if a fund launches tomorrow from another company and they say the fund tracks the S&P 500, well that's enough for me since the S&P 500 has been around for 70 years and the fund is just there to track it and match its performance. The third tip you need to learn is how to compare funds to each other to see which has a better return, lower fees, etc. So to do this, go to the chart right here and click compare chart. Alright, so we already have FXAIX selected, as you can see right here. So we're going to add 2 more funds. Each one I give you will be for a specific reason. Click the add symbol right here on the left and type in SPY. SPY is State Street's fund version of the S&P 500. So after you add that, type in SMH. SMH is a semiconductor ETF from VanEck. Alright, so once you have those 3 typed in, look above the graph and unselect all of these. We're going to leave the graph blank. I'm about to show y'all something. Make sure y'all pay close attention because I'm about to drop some game. Alright, so click the yellow box right here that says S&P 500 Index. Go down and click 1 year to see the performance of the S&P 500 Index over a 1 year time frame. Next, I want you to click FXAIX. So notice I'm clicking it right here. Notice how you barely see another line on the graph? This is because FXAIX is tracking the S&P 500 Index, as its line is smack dead on top of the yellow. Now click SPY and watch how close it is to the performance of the S&P 500 as it's represented in blue. We here have 2 funds that track the S&P 500 and you cannot see either of them when on top of the S&P 500 because again they track the S&P 500. Let's throw SMH in there and we'll clearly see a difference. Alright, so SMH over the 1 time frame is beating the S&P 500. We're going to go down here and click the 5 year. Over the 5 year time frame, SMH is destroying the S&P 500. We're going to click 10 year. Over the last 10 years, SMH absolutely decimates the S&P 500. $10,000 would be worth over $124,000, while $10K in the S&P 500 would be only worth $36,000. I want to give y'all one more curveball before we move on just to get excited about what all the market offers. I want you to erase SPY, erase FXAIX, and erase SMH and replace them with SPDN, QLD, and SPXL. So here we have it. You erase SMH, FXAIX, and SPY, and you replaced it with QLD, SPXL, and SPDN. So I want you to clear the graph again and select the yellow box for the S&P 500 Index. Go to the year to date and then click SPDN and watch the difference. So we just clicked SPDN. Now look at what you see. SPDN is the inverse ETF version of the S&P 500. So whatever the S&P 500 Index does, this does the exact opposite. If the S&P 500 goes up 10%, this goes down 10% and vice versa. Investors buy inverse ETFs to hedge their portfolios. Hedge basically just means protect. For example, if you have a lot of money in the S&P 500 and you think that the S&P 500 is about to crash, you would buy an inverse ETF. That way, if SPY goes down, you actually make money. Now take off SPDN and click QLD instead. We are looking at the 1-year time frame in this graph. QLD is a 2x leverage version of the S&P 500. Meaning if the S&P 500 goes up 10%, QLD will go up 20% and vice versa. It's not an inverse like SPDN. Go to the 1-year time frame and you can see whatever the S&P 500 does, which is the yellow, QLD exaggerated about twice as much. So as you can see, this little bump right here, QLD did it twice as much. This downward slope right here, QLD did that twice as much. This downward slope right here, they did that twice as much. This upward spike right here, they did that twice as much. Same exact lines, just more exaggerated. Now select SPXL. SPXL is the 3 times leveraged version of the S&P 500. So whatever the S&P does, times it by 3. Go to the 5-year time frame. Red is SPXL, blue is QLD, yellow is the S&P 500 index. You can see that SPXL destroys QLD and it destroys the S&P 500 index over a 5-year time frame. Now click 10 years. Over 10 years, QLD destroys both SPXL and the S&P 500 index. You may be thinking, wouldn't 3x leverage beat 2x in a 1x return? It can over the short term, but over the long term, 3x leverage is bad due to leverage decay. Leverage decay is basically what happens when a 3 times leveraged ETF goes down. If the S&P 500 were to drop 33% in one day, which is extremely unlikely by the way, but if it did happen, a 3x leveraged product would drop 99% in one day. For the S&P 500 to return back to normal, it would have to give a return of 49.25%. Just for it to get back to where it was before it dropped 33% in one day. But for SPXL to return back to its share price before the 99% drop, it would have to give you a return of 9,900% just for you to break even on your money. Therefore, the S&P 500 index would have to give you a 3,300% return in 1 year just so SPXL can go up 9,900%, since SPXL gives 3 times the return of the S&P 500. The S&P 500 will never give you a 3,300% return in 1 year. Now, if any of that was confusing, stay tuned for my leverage guide courses. I will teach you how to make tens of thousands of dollars trading different 3x products and how to long-term invest in 2x products, since 2x leverage is the historical optimal amount of leverage for investors who want a little bit of more money in their pockets. QLD is one of the best investments of all time because the S&P 500 normally ticks up over time. In other words, buy QLD if you have full confidence in the S&P 500. Here's the website you're going to go to in order for you to open an investment account. Go to www.fidelity.com/open-account or type in Google open a Fidelity account and click the first link. So here you will see a bunch of different accounts you can open. With Fidelity, I personally use them for my Roth IRA, which is a retirement account where I don't pay taxes on my stock gains. I have a regular taxable brokerage account where I do pay taxes on my stock gains. And I have a cash management account, which is Fidelity's version of a checking and savings account. I use Fidelity for everything, and I can instantly put money from my job into stocks and ETFs since they allow instant transfers between accounts. Now, if you want me to literally show you step by step how to open an investment account and give a deep explanation of the 15 different investment accounts you can open, I recommend you to take the Investing for Dummies course, where I also give you what I call the Fidelity's Holy Trinity, which are the top accounts you can open at Fidelity to make investing as smooth as possible. You can also invest as little as $1 into your favorite companies with something called fractional shares that allows you to put in however much money you have into the best companies in the world, because that's all the stock market is. It's us investing in companies that we believe in. You can literally go on the App Store right now and download the Fidelity mobile app. Do not make this hard, please. Here's how it looks when you're about to buy an index fund through the Fidelity mobile app. All right, so FSPHX is the mutual fund that we're buying today. Remember, index and mutual funds are not traded on the stock exchange. You can only buy them from a brokerage that has them. Meaning, if you were to search for an index fund on the New York Stock Exchange or the NASDAQ exchange, it would not pop up. But if you were to search for it through a broker, you would find it. So here I have searched up FHPHX and I clicked it, and here's what we have. So it gives me the account that I'm about to buy it in, which is my regular taxable brokerage account. I have the amount of money that I have available to trade or to buy stocks with. Now here I'm just about to type in an amount that I want to buy. So I want to put in $250. So note how it says this purchase will be completed at the next available price. So this could mean one of two things. This could either mean that the stock market is closed and you just have to wait until the stock market opens for your order to go through, or it means that this is an index fund or a mutual fund and you will buy it at the next available price, which is at the end of the day. So if we keep going further, notice how it says that this trade will execute after the next market close. This is exactly what I was talking about the entire time. Index and mutual funds, you have to buy it at the closing price. So again, with the stock or ETF, it doesn't matter what time you buy it, as long as you buy it at whatever the price of it is in that moment when the stock market is open. But with index and mutual funds, you will pay the same price as everyone else, the price at which the fund closes at. With both fund types, you can buy whatever amount you would like. So I just put in $250. I could have just put in $5 if I wanted to. Now the main reason the market offers both is to allow you to pick your poison. You can do ETFs and get the benefit of stocks, which allows for easier liquidity, and you can do options on them while still investing in an index instead of picking your own stocks. Or you can be chill, just go to work and have your money automatically invested in the index at whatever price, because you're not looking to actively sell anything like you would with stocks or ETF. The reason the market offers both is because of psychology. Some people want to invest in the stock market without being emotionally affected by constant price movements like you would get with an ETF or a stock. While personally me, I enjoy the thrill of it. Ticker symbols for ETFs and index funds come from the name of the company or brokers that issue them. Here's how it looks when you're about to buy an ETF through the Fidelity mobile app. Alright, so what we did here is we searched for my favorite ETF, which is SOXL. We are about to buy 28 shares of SOXL. So notice on the previous slide, the index fund did not have ask and bid prices, but the ETF does. So if y'all want to see this in real time, let's look at the previous slide. Notice the ask and bid prices right here. Notice you don't have anything right here. So that is going to be the main difference between index funds and ETFs. Remember, this is because ETFs are traded between other buyers on a stock exchange, while index funds and mutual funds are not traded. They are bought directly through the broker. So there we have it, 28 shares, preview order, and place order. So there we go. I have officially bought 28 shares of SOXL. There goes the order right there, $245. There is an ETF for you. ETFs are very flexible and can track certain sectors that index fund will not track. Here's a weed ETF for the weed smokers out there, or anyone who is optimistic about the future of weed being legalized across America. So right here, all I did was type in weed ETFs from Google. I went to a website called etfdatabase.com. Here they give us two different weed ETFs, and I'm going to click MJ, ticker symbol MJ. This is the Amplified Alternative Harvest ETF. We'll find out what company that's by here in a second. So in this specific ETF, here are the top 10 investments that make up 87% of their entire fund. As you can see, 42% of this fund is made up of MJUS, which is another marijuana ETF. Yes, you can have ETFs inside of ETFs. The performance of the stocks inside MJUS will affect the share price of MJUS and almost half of the MJ ETF. I hope that wasn't too confusing. The rest of the companies inside MJ only get an allocation of about 2 to 8% respectively. You can also view the sector weightings and see what sectors make up the most of your ETF. The weightings of these ETFs will change based on the performance of the stock. If a stock within the ETF starts doing bad, they will get pushed to the bottom, so they have less of an effect of the ETF. Depending on how bad they do, the fund managers can completely remove it and replace it with a company from the same exact sector. Because I stay true to my word, we will look up exactly what company gives out the Amplified Alternative Harvest ETF. And all I did was type that on Google, and I'm going to click the first link that pops up. So it seems that the brand is called Amplified ETFs. And here they give you a reason to why you should invest in MJ. It gives you the objective and strategy, and it gives you a whole bunch of fun documents like the fact sheet, prospectus, summary prospectus, annual report, semi-annual report, and etc. Now we'll dive deep into this a little bit later. So I like to think of it like this. The mall is the stock market. The food court is the index name or ETF name. The companies inside the food court are the stocks. The ETF exposes you to all the different restaurants that you wouldn't have known about or go out of your way to travel to get. or go out of your way to research if we're talking about stocks. It's all in one nice spot. So as you can see, you can have electric vehicle ETFs, fast food ETFs, EATs down here, and then you can have healthcare ETFs. And there are hundreds and hundreds of different type of ETFs that you can have. You can have country-specific ETFs, sector ETFs, industry ETFs, ETFs inside of ETFs, leverage ETFs, income ETFs, whatever fits your style. Here is something called VTWAX or VTWAX. This is an index fund from Vanguard that tracks the FTSE Global All Cap Index, which is an index or a benchmark that tracks every stock in the world. The ETF version of this index fund is called VT. So I tell investors that if you are older and you want safety, go with VTWAX. This is going to be you investing in the entire world. If you are younger and want risk, go with VTSAX. That is an index fund version of VTI. Remember, VTI is the total US stock market. So VTSAX is going to be the exact same thing, but the index fund version. So a lot of people will tell you to invest in the world and you will be more diversified, which is true. But me personally, I don't know about the customers. I don't know about the balance sheets, the management of companies that's overseas. I only trust the products that I use and see every day in the United States. I trust the SEC, which is basically the FBI of the stock market. The SEC is a Securities Exchange Commission, and they basically just oversee all of the stock market trading and make sure everything is legit. And I also trust that at least until I die, the US will still be a world leader. And if I'm wrong, well, that's what the option market is for, as we can bet if stocks or indexes will go up or down. So as you can see, over the past 5 years, the world is essentially up 52%. And remember, the ETF version of VTWAX is VT, also offered by Vanguard. Here are some of the best ETF providers. The most popular ETF providers based on assets under management are BlackRock with the iShares brand, Vanguard, and State Street with the SPDR brand. Other notable ETF providers include Invesco and Charles Schwab. So here's a more detailed breakdown. So BlackRock is the largest ETF provider in the world with the iShares brand, managing a substantial amount of assets. Vanguard is another major player in the ETF market with a strong presence and a significant AUM. State Street's SPDR brand is also among the top ETF providers, offering a wide range of products. Invesco is a significant provider, particularly known for the QQQ ETF. Charles Schwab is another prominent name in the ETF space. So here's the tattoo that I got from a dude on IG. His name is Dope Inc. 5. I got these 3 investment firms tatted on me, as these are the companies that essentially own our entire stock market. There goes Vanguard, there goes BlackRock, and there goes State Street. These companies have trillions and trillions in assets and have massive amounts of power. They can fund politicians, influence companies' decisions, etc. In my Conquer the Markets course, I go over how to see what investment firms own a certain stock. And all I can say is if one of these companies has a stake in the company you want to buy, it is a very good sign. They are smarter than all of us and do not want to lose money. Whatever they buy, you buy. Alright, so here's a reminder. Each fund provider can have funds that track the same exact benchmark. For example, the S&P 500 is a benchmark, and each institution has their own fund that can track the S&P 500 to mimic its returns. They do this so investors have flexibility on which fund provider they want to settle with. Some people want Vanguard, some people want Fidelity, some people want Schwab. So as you can see, these are each one of those providers' own version of the S&P 500. You have VFIX, which is Vanguard's, FXAIX, which is Fidelity's, and SWPBX, which is Schwab's. So here's the website to see all of the funds that BlackRock's iShares consist of. Just type in on Google all iShares funds by BlackRock and pick the first one. So scroll down and let's see some of the criteria we can filter through. You can filter through fund type, whether you want an index fund or ETF that is passively or actively managed. You can sort by asset class, whether you want to invest in commodities, equities, which just means stocks, or fixed income, which is a type of investment security designed to provide investors with a predictable and regular stream of income. You can also filter through markets and regions and find funds that own stocks specifically in the region of your interest. If you have morals and you want to be a moral investor, you can click sustainability and choose funds that follow a certain ethical code. Hit strategy if you're picking an ETF for a specific purpose, like interest rate hedge, currency hedge, or for fixed income. Domicile just means the country the ETF tracks. So if you want nothing but German companies, Ireland companies, Luxembourg, Switzerland, or United States companies, you can do that. I'm going to give you my favorite ETFs from iShares. Write these down. So here I'm about to sort it by assets under management. I want the fund with the highest assets under management. IVV is one of my favorites because it just tracks the S&P 500. Another one that I like is IBIT. It's the ETF that tracks the performance of Bitcoin. If you don't know about Bitcoin, it's the best performing asset in world history, where $5 worth of Bitcoin bought in 2010 would be worth $9.9 million today. Now, my favorite ETF from iShares is the IWM, which is an ETF that tracks the Russell 2000 index. The Russell 2000 index tracks the best small cap companies. I love to trade options on IWM because the Russell is extremely volatile, and its options can return thousands of percentage points on contracts that expire the same day or one day to expiration. I've made thousands and thousands of dollars by placing puts on days where the market is going down. You place puts when you think something is about to go down. You place calls when you think something is about to go up. More of that in the Leverage Guide course. Next, we have a list of Vanguard ETFs. My favorite thing to do here is sort by the inception return. So if we go over and we click to inception, here are the ETFs that pop up for the highest inception return. So the funds that return the best since inception are VONG at 17% since September 20th, 2010. The second is going to be VOOG, which is the S&P 500 growth ETF. So this basically just takes the best growth companies from the S&P 500 and puts them in one ETF and kicks out all the other ones from the S&P 500 that's not growth companies. That since inception has returned almost 17% also since September 7, 2010. You then have VOO, which is just the S&P 500, and since 2010 it has returned 14.63%. And then you have my personal favorite from Vanguard, which is VGT, the information technology ETF. It's up almost 14% since 2004. Look at that 10-year return though, 21.58%. Now compare that to the rest. Over the last 10 years, this thing has been a monster. Now remember, these are funds, folks, not stocks. Funds can still make you extremely rich without all the extra risk. Now you can type these up and look at these yourself. Now I'm going to give you a couple that are my favorite, and you can just look all these up yourself. So it's going to be VOO, VGT, VUG/VOOG, and VIG, which is a dividend paying ETF. All right, so here are all 11 ETFs from State Street Spider Funds that track each one of the 11 stock market sectors. Write these down, folks. So what you're going to do is you're going to click performance. Now remember, you want to invest in the best performing sectors throughout history, which has been technology, consumer staples, financials, consumer discretionary, industrials, and healthcare. My favorite from these are XLK, XLY, XLE, and XLV. I've made thousands of dollars trading options on XLV because healthcare has been extremely volatile under Trump's presidency, and I bet or I do put options that it's going to keep going down. SPY is also a fund from State Street that tracks the S&P 500, and it's the most popular ETF on the face of the planet. So as a bonus, because you've made it this far, I'm going to show you how to not pay fees on popular index funds. Here we have Fidelity's zero expense ratio funds that they market to its clients. Some companies like Vanguard and Morgan Stanley have minimum investment requirements to invest in their funds, meaning you cannot invest in an index fund if you don't have a certain amount to invest in. Fidelity prides themselves by offering these same funds with no minimum investment amount and no fees to hold the fund. They call them zero funds. So the top 4 of these funds are going to be Fidelity's Zero Large Cap Index Fund. This seeks to provide investment results that correspond to the total return of a broad range of large capitalization U.S. companies only. The Total Market Index Fund, FZROX, which seeks to provide investment results that correspond to the total return of a broad range of publicly traded U.S. companies. So again, that's just all companies in the U.S. You have Fidelity's Zero Extended Market Index Fund, which seeks to provide investment results that correspond to the total return of a broad range of mid to small cap companies. So this would be everything outside of the S&P 500. And then you have Fidelity's Zero International Index Fund, FZILX, which seeks to provide investment results that correspond to the total return of foreign, developed, and emerging stocks. These all have zero expense ratios and no minimums to invest in. Do not let that information go to waste, y'all. Here are the top 15 fund providers on the planet by assets under management. So notice the top 3 again: BlackRock, Vanguard, and State Street. Now these are all good companies to buy funds from. It just comes down to your preference. So what I want you to do is go on Google and search the funds that each of these offer and use the Fidelity Fund Screener to compare the ticker symbols of each of these funds. Here are the most popular funds in stock market history. Starting with mutual funds. We have FCNTX, which is Fidelity's Contra Fund. We'll take a look at it on the next slide, but this is a fund from Fidelity which tries to handpick growth stocks in order to beat the S&P 500. You have FNCMX, which is Fidelity Nasdaq Composite Index Fund, and it tracks the Nasdaq 100. Then you have MSEGX, which is Morgan Stanley's institutional growth portfolio. They too try to handpick stocks to beat the S&P 500. The most popular index funds, VFIAX, which is going to be Vanguard's 500 index fund. That tracks the S&P 500. You have VTSAX, which is Vanguard's version of the total U.S. stock market. Then you have FXAIX, which is Fidelity's version of the S&P 500. Then you have the most popular ETFs, VOO, which is Vanguard's S&P 500 ETF, SPY, which is State Street's version of the S&P 500, VTI, which is the ETF version of the total U.S. stock market, and QQQ, which is Invesco's version of the Nasdaq 100. All right, so here is the Fidelity Contra Fund. So let's scroll down to Fund Research by Fidelity and see what the FCNTX is talking about. All right, so this is the screen that you will see when you click the link. So let's break down everything that we're looking at. All right, so first off, here's where you can buy and sell the Fidelity Contra Fund. Here we have the price that you will be buying at. This is the NAV price, which just means net asset value. It's the same thing as a share price, but because funds are not traded on a stock exchange, they technically don't have a share price. Instead, they have an NAV, and that NAV or net asset value is tied to the performance of the holdings within the fund. As you can see, they have a 5-star rating, high returns, medium to low expenses, and is moderately risky. Look at the performance. The 1 year, almost 27%. The 3 year, almost 26%. The 5 year, 17%. And the 10 year, 15%. Those are some amazing returns. Now let's scroll down and let's look at the details. Its category is large growth. Its fund inception is in 1967. Its expense ratio is 0.63%. This just means for every $1,000 you put in, you pay $6.30 every year to the fund manager. That's extremely low for these kind of returns. We'll discuss fees later, but a good rule of thumb is to aim for a fund with fees less than 1%. Anything over 1% needs to give you amazing returns over its entire inception. I'll tell you right now, I looked at thousands and thousands of funds over my 6 years in the market, and one thing I tell you is that it's always better to invest the bulk of your money in index funds instead of active funds, because all it takes is a change in fund managers or a change of the top holdings, and you didn't know they did it, and you end up with a return that's less than the S&P 500. Combine that with a large expense ratio, and you can seriously underperform the S&P 500. The only high expense ratio products I would buy is leveraged ETFs, as the returns absolutely outweigh the high fees. Look at the hypothetical growth of $10,000. Over the last 10 years, if you put $10,000 in the S&P 500, it would be worth almost $36,000. But with FCNTX, it's worth $44,000. You can see the top 10 holdings, and the top 10 holdings make up almost 57% of the total portfolio. It has 404 holdings, and its top 10 is Meta, Nvidia, Berkshire Hathaway, Amazon, Microsoft, Netflix, Amphenol, Google, Apple, and Eli Lilly. You can see some similar fund picks from Fidelity, and you can see the fund managers. Click on one of these and you can read about them. Let's see what Ash are talking about. So here's a bunch of funds that they previously or currently manage. You can also see things like a Q&A. So if we click on Q&A, so somebody right here asked him, as the year unfolded, did you make any notable changes to the fund's positioning? He responded, most fund holdings are well positioned. Nicely profitable sector leaders run by proven and trustworthy management teams. The embrace of artificial intelligence by companies, governments, and individuals was the biggest trend in the markets this year. AI will affect every business, so the Fidelity research team, Jason, Asher, and I are trying to identify winners and losers in this changing tech landscape. You can also see their investment approach. They said the Fidelity Contra Fund is an opportunistic, diversified equity strategy with a large cap growth bias. Now, what I just gave you was something that you can do with every fund on the planet. I have spent days and weeks just going through different funds and seeing what they offer. Do not let this information go to waste. Here are some of the best performing funds in history. Started with mutual funds. FSELX, which is the Fidelity Select Semiconductors portfolio. They're up almost 3,600% all time. Now, most of these I'm not going to read the name of because I want y'all to go see it for yourselves. But we have LDVIX and we have TFOIX. Now we have index funds, VTSAX, VFAIX, and FXAIX. We should all know what those are by now. Then you have the ETFs. You have GBTC, which is Grayscale Bitcoin Trust, and that just tracks the performance of Bitcoin. You have TECL, which is one of my favorite leveraged ETFs. It's the Direxion Daily Technology Bull 3x Shares ETF. Then you have TQQQ, which is a triple leveraged version of the NASDAQ 100. So whatever the NASDAQ 100 does, this times it by 3. It's up over 19,000%. Now what I want y'all to do is go get that investment calculator and see what a 19,000% return would do for you and your family. How much would $10,000 be if it got a 19,000% return? Hey man, I know y'all lazy, y'all ain't finna do it, so I did it for you. That's turning $10,000 into $1.946 million. That's almost $2 million from $10,000. Go ahead and add TQQQ to your watch list. Buy TQQQ whenever the stock market crashes. And y'all will see why I say that if y'all take the Leverage Guide course. Here are some popular strategies and portfolio allocations. So investing is a game of strategy, and having the right investments that match your risk tolerance and age of retirement can significantly impact your investment returns. So the first strategy we have is a 3-fund portfolio. This is going to be a total domestic market, a total international market, and a total bond market. So you can do something like VTSAX plus VXUS plus VBLTX. Number 2, you have the set it and forget it portfolio. This is also called a 1-fund portfolio, where VTWAX is the only thing that you will buy. This is you buying the whole world. Remember, VT is the ETF version of VTWAX. Number 3, you have the all-weather portfolio. This portfolio was created by Ray Dalio, and this is a portfolio that can possibly survive a market crash and is fit for any world scenario. Number 4, you have VTI and Chill. This is where VTSAX is the only thing that you will buy. VTI is the ETF version. So this is you only investing in the United States. Number 5, you have 2 index and 2 tech. This was created by Ian Dunlap, aka the Master Investor. This is where you have 2 index or ETFs like VTSAX and QQQ, and you just add on 2 tech stocks like Apple and Microsoft. Then you have what I call the Leverage Guide portfolio. This was created by me. You have a normal ETF like QQQ, which is 1 times leverage. Then you add the same version of it, but 2 times the leverage. So QLD could be 1. So you regularly put money into a 1X ETF like QQQ, and 1X just means normal version, no leverage added to it. Then as the price of it gets lower, you put more money into the 2X leverage version of it, which is QLD. And then if it crashes even more, you put money into a 3X leverage version of it, like TQQQ, which is 3 times the NASDAQ. Because remember, the stock market indexes go up over time. So even if it crashes, regular people are going to be buying QQQ. But what I want you to buy is QLD and TQQQ. This is how you're going to turn 10,000 into 1.9 million. Don't say I'm trying to help you change our life. All right, so a common rule for creating and maintaining an investment portfolio is while you're younger in age, you want to take as much risk as possible, and as time goes on and you get closer to retirement, you become risk adverse and you switch up your investments from risky to safe. Risky investments give you more growth, but since you're close to retirement, you don't want to risk blowing up your retirement account in some growth stock. As time goes on and you get older, some professionals recommend you to increase your bond exposure and diversify your investments across the world a bit more, instead of being heavily weighted in U.S. equities. Now, because I'm young, I'm 100% invested in the United States, but as I get older, I'll switch to bonds and emerging markets. Bonds are just investments where income is guaranteed. I do a deep dive on bonds in my Conquer the Markets course. So here's an example of a 3-fund portfolio. You have an aggressive 3-fund portfolio. This can be used between the ages of 20 to 40. You have 10% of your portfolio in a total bond market fund. You have 36% of your portfolio in non-US stock market, so like international. And then you have 54% of your portfolio in a total US stock market, so like FTSAX. Here you have a moderate 3-fund portfolio. This is something you can do when you're 50 years old. So you up the allocation to bonds. Now you have 24% of a total bond market fund. You have 30% of a total non-US stock market index. And then you have 46% in a total US stock market index fund. And then here's a conservative 3-fund portfolio. This is something you can do when you're 65 years old. You switch to 50% bonds, 30% total US stock market, and 20% non-US stock market. Here is the all-weather portfolio. Ray Dalio is the one that came up with this portfolio allocation to be able to survive any type of stock market environment. You have 30% of your portfolio in stocks, 7.5% of your portfolio in commodities, Commodities are just raw materials that are used to produce things we buy. Commodities are things like gold, silver, oil, copper, etc. You can add commodities to your portfolio by owning something like a gold ETF like GLD. Gold is going to be 7.5%, intermediate term bonds are going to be 15%, and long-term bonds are going to be 40%. So here's a bonus one. Here's the Dave Ramsey portfolio. Dave Ramsey recommends your portfolio to be split in 4 different categories: growth, income and growth, aggressive growth, and international. So growth and income would be large cap, blue chip dividend income, and equity income. Aggressive growth would be small cap companies in emerging markets. Internationals would be foreign funds and overseas funds. They would each get 25%. Alright, so here I have a chart that I made myself that gives you a rough guidance of the asset types you should be investing in as time goes on, based on the level of risk. So to start off, if you are 18 to 30, I do not want you to be invested in low risk investments. I want you to use the power of compound interest and invest in riskier assets like tech companies or 2x leveraged ETFs to maximize your potential returns over your lifespan. If you are 18 to 30 and you want medium low risk, I would suggest you invest in an S&P 500 index fund or just blue chip and large cap stocks. If you want medium risk, I say invest in a NASDAQ index and large cap growth stocks. If you want medium high risk, I would suggest invest in mid cap growth stocks. If you want high risk, I suggest small cap growth stocks. And if you want ultra high risk, then you can trade penny stocks, leverage ETFs, or do option trading. Now, I really don't recommend anybody to do penny stocks. I would much rather you to learn option trading or learn about leverage ETFs than fool around with penny stocks. So if you were 30 to 50 and you want a low risk investment, I suggest dividend ETFs and bonds. If you want medium low risk, do an S&P 500 index fund and invest in large cap dividend companies. If you want medium risk, do a NASDAQ index and large cap growth stocks. If you want medium high risk, mid cap growth stocks. High risk, small cap growth stocks. And here's an asterisk, and the asterisk just means it's up to the individual investor if you think you are savvy enough and sophisticated enough to deal with penny stocks and option trading. As long as it's a small part of your portfolio, you will be alright. If you are 50 to 70 years old and you want low risk, dividend ETFs or total world index, and you can throw in some bonds. Medium low risk, S&P 500 large cap dividend companies. Medium risk, NASDAQ index large cap growth stocks. And here we have asterisks on the medium cap and small cap growth stocks. Again, if you think you can do that and you're 50 to 70 years old, go for it. I don't recommend it, but you do what you're gonna do. And if you are 70 and 100 years old, I don't even know if you're gonna be watching this, but you need to do a total world index, stick your money in bonds, and put half of your money in a money market account. I don't even really want you to be invested for real, unless your money is in a trust and you're already a millionaire, but then again, you probably wouldn't even be watching this. Now, a keynote. I want you to minimize the exposure to dividend paying investments while you are younger. Notice how this 18 to 30 has no dividends on it. I only started saying invest in dividends when you're 30 to 50. You need to replace the dividends with growth. The only exception is if you have a very high net worth before 30 years old and you want to live off your dividends. Normally, investments that pay dividends are much more stable and therefore their share prices don't go up as high as non-dividend paying assets do. Now, none of this is what you have to invest in. This is just a general guideline. So here's a sample portfolio for a 30-year-old risk-adverse investor who has $10,000 to invest. I would do a 3-fund portfolio and I would invest in SPY, QQQ, and VXUS. SPY, of course, tracks the top 500 companies in the United States. QQQ tracks the top 100 tech companies in the United States. And VXUS tracks all international stocks. I would do an allocation of 42.5% to SPY, 32.5% to QQQ, and 25% into VXUS. Risk adverse means you do not want to take a lot of risk. And since you're 30, you can definitely deal with the volatility from the SPY and the QQQ, and you can have VXUS kind of calm your portfolio down in the background. Again, if you were 60 years old, I would not recommend this portfolio, even if you were risk adverse. Now, if you were 60 years old, I definitely would not recommend this portfolio. But because you are 30 years old, even if you want risk adverse, these are still assets that go up over time in a safely manner. Remember, the indexes are volatile, not risky. Here's a sample portfolio for a 30-year-old risk-on investor who has $10,000 to invest. Risk-on just means he wants all the risk. So what I would do is I would do SSO, QQQ, and XLV. SSO is Ultra S&P 500. This is 2x the S&P 500. I would do the regular version of QQQ, the NASDAQ 100, and I would do XLV, which is the healthcare ETF from State Street Spider. I do 40% in SSO, I do 30% in QQQ, and I do another 30% in XLV. Here's a sample portfolio for a 60-year-old risk-adverse investor who has $10,000 to invest. I would do 50% VTWAX, which is all the stocks in the entire world, and I would do 50% in a money market account. A money market account is a deposit account that combines features of a checking and a savings account. So Fidelity has a popular one called SPAX, SPAXX. It will pay you a return of 4% per year, which is way better than that savings account you got right now. Even though this is a course on index funds and ETFs, you can still contribute to a money market account at any time you want to. This is all part of investing. Here's an example of a bad portfolio. Here we have an example of a 3-fund portfolio. So you have SPY, you have VOO, and you have VTI. So these are all great funds to invest in. The only problem is that they overlap. Overlapping a portfolio means you have multiple different funds or investments that all track the same index or have the same stocks in them. The above funds nearly track all the same benchmark, the S&P 500. SPY tracks the S&P 500 as well as VOO. They're just funds created by two different companies that track the same benchmark. You may think you are diversifying your investments with VTI, but you're not. VTI is the total US stock market, which includes medium cap and small cap companies that the S&P 500 does not include. VTI is made up of all the large, medium, and small cap companies in the United States. All of the companies in the S&P 500 are in VTI, but not all companies that are in VTI are in SPY. The S&P 500 tracks large cap stocks only, while VTI is everything. A much better way to fix this would be to invest in one fund that tracks the S&P 500, i.e. State Street SPY, or just invest in VTI. The returns for both of these funds are almost exactly the same anyway. So here's an example of a good portfolio. Here we have a 3-portfolio again, and we have a total stock market ETF with VTI, which is every stock in the US stock market, a Vanguard dividend appreciation ETF, which are the best companies that pay dividends, and we have a total international stock market ETF, which tracks the top companies outside the US. In this portfolio, we have minimal overlap as the bulk of our portfolio is in domestic stocks and 30% of companies are outside the US. The premise behind having international stocks in your portfolio is that we never know if the United States will continue to be a dominant world leader. Other countries could catch up and their stocks could start going up. The last 15% right here is for those stable but juicy dividend payments sent directly to your investment account. Alright, so here's a free tip. Go to ETFoverlap.com. You can already guess, but this is how you find if your ETFs overlap. So here you have two funds. You have SPY and you have VOO. You can type in any two funds that you want to. But here you can see that these two funds have a 99% overlap. 498 companies overlap. So it's literally no reason for you to invest in both of these. Just pick one and invest with them. 99% of the companies that's in SPY is also in VOO and vice versa. So here is SPY and here is VXUS. Remember, SPY is the top 500 companies in the US. VXUS is the top international stocks. Notice they have a 0% overlap. 0 of the holdings overlap. This is what you want to see in your portfolio. Overlapping stock portfolios where multiple funds or investments hold the same or similar stocks can significantly reduce diversification, increase your risk, and potentially lead to higher costs. This happens because your portfolio becomes overly concentrated in a few stocks or a few sectors, making it more vulnerable to market fluctuations and negative performance in those specific areas.